Hello, and welcome to Portfolio Matters, Week 12 Weekly Update. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So, what have you got for us this week, Keith?
Well, the big news of the week was the Fed actually let the special lending reserve requirements lapse. And remember a couple of weeks ago, we were talking about how this could result in banks having to sell their holdings of US treasuries, causing yields to rise and they wouldn't be able to buy anymore, etc. And it was all going to be a catastrophe, according to Zero Hedge. Well, nothing happened. Bond yields actually fell quite heavily on the week. So there you go. I think an example of banks lobbying heavily for regulations that suited them. But the big news of the week was that Europe is doing very poorly in its vaccination schedule, and as a result is going back into lockdown, and that caused a big reaction in travel stocks and also in oil, which fell heavily on the week. Okay, so moving on to the charts. One thing that caught my attention, I think, was partly to blame for the sell-off we saw in equity markets during the week, was the New York Fed nowcast. So what they do is they look at real-time US data, and they use that to forecast the Q1 and Q2 GDP data. And essentially, the latest data was quite poor, led them to revise down heavily their estimates of Q1 and Q2 growth. So you can see that previously they were estimating that US Q1 GDP growth would be 8.6%, which is amazing, and they've downgraded it to 6.3%, which is still good, but that is a big step change down. And if we look at Q2, previously they were expecting 4%, and now they've massively downgraded it to 1.2%. Now, obviously, this gets updated real time every day, so lots can change. And friends of mine in the States are talking about how activity is really busy at the moment in Texas, and that it's impossible to book a table in a restaurant. So there's anecdotal evidence that things are doing well in the US, but right now, the nowcasts look pretty poor. Richard.
So this is my chapter recovery.org economic activity graphs. Total small business revenue has started to pick up again since around about the end of February, but it is still 27% down from where it was before COVID. So your friend may be seeing an upsurge, but the data this is admittedly historic data, but that's not showing through either here nor on the next slide, Keith, where we have the number of small businesses open. And in fact, that while it picked up a couple of weeks ago, now appears to be declining again. So it may be highly dependent on the sector you're looking at, but I would say that from an economic point of view, this is not especially good news from the US, and so we've probably got some contradictory data swimming around as well.
Well, I think what we've just seen, Richard, is that the charts are showing actually activity is quite weak in the US, and the markets may have temporarily got a bit ahead of themselves, but I think we are still expecting a very strong recovery later this year.
Just a quick one of the Federal Reserve balance sheet, which continues to rise in a fairly steady diagonal line at the moment. And if the stock market, the overall level of the stock market is linked to the US Federal Reserve balance sheet, then there's no particular reason why the stock market should decline.
Absolutely. Now, returning to inflation. Inflation is picking up. So these are the prices paid, which is the solid line, versus the prices received. So what the Philadelphia Fed, the businesses that it has surveyed, are seeing their input prices rise massively, but they haven't yet been able to pass on those prices to customers. So their margins are being squeezed. But you would expect them to be able to pass those prices on later in the year. So I think what this is showing is there's inflation in the system that will appear.
Yeah, and also if you just sort of try and interpolate where the dotted blue line is likely to go in comparison to where it's gone previously, Keith, you may be looking at sort of above between 40 and 50 as the line it might move up to, which would take it to a higher point than it's been since the inception of this graph.
Yes, very good point. And these are the prices of goods imported from China into the US. And historically, Chinese imports have been cheaper than US goods, and so it's been a deflationary force. And what this is showing is now the price of goods from China is rising, and it's an inflationary force.
One of the things that's just happened this week is it was the Evergreen bulk carrier that is blocking the Suez Canal, and ships are going to have to be rerouted around Cape of Good Hope. And the concept there is that that's going to cause significant delay in deliveries, which could also cause a shortage of supplies and an increase in, obviously it would be temporary, but a temporary blip in inflation levels as well. So there does seem to be quite a lot of inflationary pressure around.
Well, I completely agree with you, Richard. Now, one of the things we've talked about in previous weeklies is the Chinese credit impulse and the fact that it is declining now as the Chinese stimulus begins to wear off. And you can see that happening in that Chinese copper imports are falling from their peak, although they still remain very high. Now, this is a chart showing US mortgage lending by customer credit score. And what it shows is that the US banks, the vast majority of their lending has been to customers with the highest credit scores. That's black. You see, the lower down their credit score, the less lending there is. So there is a lot of opportunity for lending to people with lower credit scores later. Moving on to the vaccinations, and essentially the EU is not doing well. If we go onto this chart, is that at the top is Israel, which has done an absolutely amazing job and has actually now vaccinated more than the entire population. So people are getting their second jabs. The United Arab Emirates are doing well. We are third. Isn't that marvelous? And it's a very nicely shaped graph. So almost 50% and rising at a rate. US is doing well. And then down here we have Europe, who are really doing very badly in comparison. And what is worrying is the slope of the line. At this rate, it's going to take them years to get anywhere near vaccinating the whole population.
I think the longer lockdowns last, the damage they do it's not linear, it's exponential. And at this stage, you really need to get out of your lockdowns as quickly as possible in order to avoid doing ever increasingly severe damage to your economy.
Hopefully, things are going to improve in Q2 when Europe starts to get almost as many vaccines as the US. So left is the expected Q2 availability of vaccines for the US, and on the right it's Europe. And you can see Europe should get a load of Pfizer vaccines in Q2, and so it should be able to accelerate its vaccination campaign, which would be great. And if we look at the world in total and availability of vaccines, by the end of the year, there will be 7.96 billion vaccines available, which is more than enough to vaccinate everyone in the entire world. So, hopefully by the end of this year,
everyone in
made
the entire world
a great deal of progress. Sorry?
Everyone in the entire world once.
Once, yes. That's right. Okay, now on to something entirely different. So the Bernholz threshold is about hyperinflationary episodes. And what Bernholz did was he looked at every hyperinflationary episode in history, and he came up with a rule that hyperinflations tend to be triggered after governments borrow more than 20% of GDP, so the fiscal deficit is greater than 20% of GDP, and simultaneously the central bank prints more than 20% of that. Okay, so it's buying more than 20% of the government's debt. And this chart, which is frankly a very poor chart because it's got two separate scales, shows that actually, despite all its money printing and running enormous fiscal deficits, Japan has only crossed that threshold during the COVID crisis. So the way to interpret this terrible chart is the budget deficit is the red line, and the 20% is this red horizontal line here. So actually, through most of the history, the budget deficit has been less than 20%, and 20% is an enormous number. But over the course of early 2020, it crossed that threshold. And the black line is the government, central bank monetization of government expenditure. And you can see that the red line has only been above 20% and the black line above 20% only briefly during the COVID crisis. Now, going forward, the government deficit is forecast to keep on rising.
Interesting, Keith. So if you use just back of the envelope calculation, the Federal Reserve, US Federal Reserve balance sheet has increased by about 4 trillion over the last year. Which is about 25% of US GDP.
Yes.
And their government debt has increased by about 10 trillion, or maybe less than that, 5 trillion, I don't know, which is, again, over 20%. So has the US actually crossed the Bernholz threshold?
Well, I think that the deficit is certainly going to have crossed it. But I don't think the monetization is going to be I don't know actually, but certainly the fiscal deficit will be above it. But anyway, frankly, I don't think there's any danger of hyperinflation at the moment. So anyway, moving on. Weekly checklist. Equity markets had a bad week. The standout was Bitcoin that came off from its highs. Richard?
Yeah, it's a bit of a standout, wasn't it, Keith? I think there are various comments have been passing around about whether central banks might try and regulate Bitcoin, and I think that has probably spooked the market a little bit. And personally, I don't think they'll try and regulate it in a way that does anything other than make it more safe and more secure. But I think the theory is that if they regulate it, then people won't want to use it because they use it for nefarious purposes, which I disagree with. So I'm fairly relaxed. Actually, I'm fairly relaxed about it. As you know, I cut my holding by 2/3 a few weeks ago, and I'm glad I did. And I'm just going to stick with what I've got now. And basically the same is true for Ethereum. Which is the next graph, Keith. Yeah. Very similar shaped graph. I'm sticking with the adoption profile. and that the value goes up with the adoption in an exponential style. The adoption's continuing to go up, I guess. So,
Right. And go on, you go.
So US dollar index, I put that line in just to sort of show where the trend was between 2012 and very roughly where and now. Clearly, the index late last year, early this year, late last year fell through that line, and it's bounced up and actually it's hit it again now. So the question is, I suppose, is US dollar index going to continue to increase and go through that line, or will it come back down again? There's been a huge amount of debt issuance by the US government recently, although, of course, they've been sending out the checks, but the Treasury General account is what's funded a lot of it, which was money that was already borrowed and was sitting in the US government Treasury's bank account. So they haven't actually had to issue debt in order to fund a lot of the more recent expenditure. What do you think, Keith?
Well, I think they're going to have to issue a hell of a lot of debt, and that will cause interest rates to rise. I think the outlook for the US dollar very much depends on whether they allow interest rates at the long end to rise as much as they naturally would. Yeah. If they start to implement anything like yield curve control, then the dollar index dives. So frankly, watch this space. The thing is, historically, when you have very high levels of debt, the economy becomes very sensitive to changes in interest rates. So my main prediction for this cycle is volatility. Yeah. I think that changes in interest rates will change economic conditions quite quickly.
Yeah. So this is a graph for the FTSE over the last 35 years. And the interesting thing is that between 2000 and now, it has actually gone nowhere. Clearly, this doesn't include dividends. But in terms of the numerical value of the FTSE, it's gone nowhere for 20 years. And if you compare that to the DAX, my next graph, DAX has not behaved in the same way at all. It has gone up since 2000, it's gone up about threefold. So a very big difference there.
Yeah. I think a lot of it is due to the fact that the FTSE is heavily weighted towards banks, which have been terrible, and also towards commodity stocks, which have also been terrible, frankly.
In Germany,
but that may be changing, Richard.
It may be. Germany has quite a large number of technology stocks, I think, doesn't it?
Okay, so on to industrial commodities. And aluminium and cobalt both were fairly flat. Copper had a bad week, but remains towards its highs. Iron ore is coming off its highs. Lithium was flat. Neodymium was flat as well, and nickel. Vanadium had a poor week, as did oil. And the oil, the 2.1% fall in oil over the course of the week masks a lot of volatility. Thursday saw the price fall by 7%. And then uranium had a very good week. Richard, uranium.
Yeah, so the uranium, the story of uranium, as our viewers probably know, is that there is a purported looming shortage of uranium where long-term contracts that power station operators need to put in place in order to secure their uranium over a period of years have fallen away, and currently a lot of them are apparently buying on the spot market, which is cheaper. And the issue is that if you buy via a long-term contract, it can take several years before you actually receive the uranium from that contract because it has to go through the processing. So the theory is that there is a looming and sudden deficit in the uranium market. And there are a lot of people who are firmly convinced of this. I think it's quite likely that it's the case. So I have a uranium holding in a company called Geiger Counter Investment Trust. And I think so it's very important not to get carried away in this market. As you can see from this graph, it's really gone nowhere for probably 7 or 8 years. And you could say that in 2014 there was a false start. There was a false start in 2020, and there may be more false starts. So tread carefully would be my thinking there.
Yes, well, I'd watch it. I mean, I think the thing is that once momentum starts to build, you might want to join in. But we've been hearing about uranium for so long now. I've become quite cynical about it. Okay, so oil. Now, regular viewers will know that I like playing the oil cycle, and one of the reasons I've had a bad week is that oil has had a bad week. And sadly for me, I think the latest news about the oil market is really quite bearish currently. So this is the chart showing US crude oil stocks. And if you include inventories of finished products such as petroleum, you still get this same chart. And what it's showing is in the last few weeks, stocks have been rising. So supply has been bigger than demand. And if you think that OPEC have taken something like 7.5 million barrels out of the market, and the market is still oversupplied in the US, that's not good. That is not bullish. Now, there is a seasonality pattern here, but you would hope that with the US recovering and OPEC completely in the control of this market, that frankly inventories would be falling, and they ain't. So the bottom line is it's difficult to see the oil price rising when inventory levels are rising. And this is the pattern for the world as opposed to just the US. And you'll see, so the blue line is rest of the world excluding China, and oil inventories are rising. Not great. And this is the oil chart, oil price, and you see, obviously WTI hit -40 last year, and the recent sell-off has been a bit of a blip. So, I just don't think you're going to see much upside in oil from here until inventories start falling again.
And that's probably going to require reopening after populations have been vaccinated, isn't it, Keith?
Absolutely. So, but I'm an investor primarily, and a few months of oil price going nowhere should not matter at all in the long term. In a 1 or 2 year view, I think the oil price heads higher. However, one of the big marginal consumers of oil is air travel. And one of the reasons the market is in oversupply at the moment, and OPEC have had to take oil out of the market, is that there's very little international travel. Now, a bearish argument for the return of fuel demand, jet fuel demand, is that during the COVID crisis, it seems that airlines took the opportunity to retire old aircraft and switch to more modern ones. So you'll see here that the EIA is projecting that the number of air passenger miles will return to previous levels by about 2024, but the industry won't consume as much jet fuel until 2030 because planes are getting more efficient. Okay, now this is a plea for information. So we continue to get feedback on our videos on the vanadium market and vanadium redox flow batteries, saying that we are missing information and that vanadium redox flow batteries will be competitive. Now, I would like to find out what the relative costs of vanadium redox flow batteries are compared to lithium-ion. And you'll see in that video, we stated that industry commentators were saying that VRFBs were twice the cost of lithium-ion. Now, I can't find any quotes for the price of VRFBs per kilowatt hour. If anyone has that information, please can you send it to us? What I have found is this chart showing the price of lithium-ion battery packs and how they've been falling. And this year, Bloomberg are reporting that lithium-ion battery packs for Chinese e-buses have fallen below $100 per kilowatt hour. Now, you'll see just how much a price fall that is over the last decade.
Mm-hmm.
It's over $1,000 per kilowatt hour back in 2010, and now they're reporting below 100. Yeah.
Well, I wonder, Keith, there's going to be materials costs, design efficiencies, and manufacturing competition or profit in there, isn't there? It'd be interesting to know what element accounts for each, because if you're investing in lithium, the price of lithium is, as we know, is going up. So there are significant economies being made that aren't reflected in the price demand interception of lithium. So there's significant technological improvement, presumably.
Well, I think actually the vast majority of it is probably just production improvements. I mean, because the thing about lithium-ion batteries, Richard, is that you produce lots of these tiny cells. So, you learn by doing in a classic manufacturing improvement process.
I suspect there's quite a lot of technological improvement as well in just increasing the fundamental energy density of the battery.
Yeah.
Interesting.
Now, when Richard was talking earlier about the relative performance of the DAX, and actually the biggest bubble recently has been in European green energy stocks. Mm. And on this chart, European renewables are the fluorescent green line, and the NASDAQ is this dark bluey grey line. So the NASDAQ's returned 177%. European renewables have returned 215. So, beware of European green energy stocks. Okay, moving on to precious metals. Still making no progress, frankly, despite the fact that interest rates, the bond yields, actually fell during the week. So gold was down just under 1%. Silver had a poor week, down 3.8%. Platinum had a poor week, down 4%. Rhodium bounced back, and Palladium was down to 2.4%. Richard?
Yes, this is a graph I came across this week, Keith. It's comparison of gold versus the dollar value of the S&P index from 2011 up until now, and it shows a continuous fall. Then it broke through it in October 20, and now it's back down. So the argument of the person who posted this is that the ratio is retesting the downtrend line and will bounce off it. So it may do, or it may not.
Yeah.
But I just think that, I like this sort of graph because it's interesting and it gives you a sense of where things are in a relative value point of view. But I also think, they are not a sure predictor of what's going to happen, but they are interesting.
Yeah. Okay. Deeply skeptical.
And this is one that Keith found that we agreed that I'd talk about because it's quite a complicated graph. So the blue is the gold price, and the red, if it's red, is the 30-year yield less core CPI inverted. And when you plot those two together, you get quite a close fit. I would just point out that it's only been plotted since 2013, and one of the things that one has to be aware of, I guess, there's two things. One is spurious correlation, and the other one is temporary correlations that break down. And I'm not really sure in this world of huge quantities of money printing and massive quantities of debt and so forth, how long is this relationship, if it is a genuine relationship, sustainable? I don't know, but I suspect that at some point the current quite close relationship between interest rates and gold may break. And if it does do, it might break quite suddenly. But again, we'll see.
Well, I'd agree with all that, Richard, but right now what it's showing is that there is a negative correlation between interest rates and the gold price. So rising rates are bad for gold.
It is certainly suggestive of that, Keith, yes.
Yes. Okay, so rhodium bounced back during the week towards its highs. It's come off a little bit in the last couple of days. Palladium is sticking to its recent highs as people switch out of rhodium into palladium. And rates had a bad week, or a good week, in that rates fell, so bonds rose. And you'll see actually there were quite large changes. I mean, the 30-year fell by 11 basis points.
About 9%, Keith, or something, 8%, isn't it? It's a fairly big change.
It is a big change. Also, we had February RPI numbers, and actually it showed UK CPI fell compared to January, which I was surprised by, frankly. Certainly, there is very little inflationary pressure at the moment, but we expect that to rise over the course of the year. And so this is the UK 30-year gilt, and you can see that the rate fell quite sharply last week. I mean, it now seems to have stabilized for over the past month. So, but I still expect gilt yields to keep on rising over the course of this year.
Thank you, Keith. So my portfolio was down 1.3%. Gives me a year-to-date figure of 3.4% up. Purchases, I bought some more Hecla Mining, which is the largest silver producer in the US. And I bought the coffee ETF, which I'll talk about in a moment. And I had a partial sale of my BP shares for a profit of 9%, which I used to fund the above. So this is the coffee ETF that I bought, and as you can see, it hasn't really gone anywhere for quite a long time. It's fluctuated between like $90 and $65. So this is an article from MacauBusiness.com. So basically it says that Brazil, the world's biggest coffee producer and exporter, could see its 2021 harvest shrink by as much as a third this year. That's 2021, mainly due to drought. The TONAB, Agricultural Statistics Agency, said. So the harvest will be between 21 and 30% lower than in 2020, which was a record year. And the Arabica coffee plant, which is the nice coffee as opposed to the Robusta, which is less pleasant, is 77% of Brazilian coffee production. And it apparently alternates high and low yields from season to season, which I didn't know. So with Arabica beans, the Brazilian production could decline by as much as 39%. So I just thought that it was worthwhile having a little bit of a punt on whether the coffee price goes up. And I shall be watching this quite closely. If it goes the wrong way, I shall be out in a shot, I can assure you.
Very good. Interesting.
Thank you, Keith. So silver. So I'm quite intrigued by the way silver is reacting. It seems to have put in a little bit of a floor at around about the $25 mark. And my suspicion is that it's not going to go any lower than that. Case of famous last words. And if it then starts to rise from there, silver miners, which have been a bit bashed around over the last few months, could benefit quite significantly from it. So I bought a bit more Hecla Mining. And this is my usual check of the what the silver market's looking like from a retail point of view. The 5 kilo silver bars are still in stock, so there ain't no shortage yet. So ferroalloy resources, which you'll know Keith is a very good review of about 2 weeks ago. 2 weeks ago, Keith?
Yeah, I think so.
And Keith and I both bought shares in it. It's underwent quite a hair-raisingly large decline in terms of the actual percentage, the actual value from sort of like 45 pence down to 26 pence. But I did a Fibonacci retracement on it, which is my sort of comfort blanket when I buy a volatile share. And the Fibonacci retracement actually hit 50% yesterday, and today I noticed that the shares are up 20%. So, I think it might be quite volatile. It may hit the 50% and bounce up, and the bounce may then continue up. But it's just something that keeps me settled. So I thought it was interesting.
So, Richard, what website do you use for that?
I've got an IG account, Keith, and
right, okay.
They've got some quite useful little drawing tools, and this is one of them.
Okay, great, thank you.
So that's my weekly update, Keith. What about you?
Thank you, Richard. Right, well, I had a very poor week, I'm afraid, on the back of oil coming off quite heavily. I was down 2.9% on the week, which takes me to just up 1.6% on the year, and I am seriously underperforming the all share, which is disappointing. Now, I had 2 sales this week. So my main sale for the week was Altisource Portfolio Solutions. Now, you'll be aware that Richard also owned this share and sold it a couple of weeks ago, and it has taken me a couple of weeks for the information to reach the brain. But anyway, Altisource do the administration on mortgage-backed securities in the US. And they make money when mortgage-backed securities need administration done. And what that means in practice is that when mortgage holders are in difficulties, Altisource does all the paperwork. Now, my interest in Altisource was because I thought that COVID disruption would lead to borrowers being in financial difficulties, and that would lead through to lots of work for Altisource. And this is what exactly happened after the financial crisis. So you see, in 2010, the financial crisis, lots of people got in difficulty with their mortgages, and over the next couple of years, Altisource had a lot of work to do, and its share price went up 16-fold. But this time round, the Biden administration and the Trump administration before it have put in temporary blocks on repossessions. So Altisource actually don't have much work at the moment, and they have guided that they don't expect any pickup until next year. And in the meantime, they're running out of cash. Now, I had previously been very committed to this trade. And what happened during the week was I thought, there's an old saying in the market, you can try to be right or you can try to be rich. And I really liked the idea, and I was committed to the idea, but actually I thought, in this case, I'm trying to be right, and I should sell it, see what happens. You can always get in later. Yeah. So I sold everything, and I will continue to watch it. But Richard was ahead of me.
I think you've done.
Okay, so what did I buy?
I think you've done exactly the right thing, Keith, and I agree with you. I mean, it seems like it has a great deal of potential, but maybe timing is the key on that one.
Yeah. And well, the bottom line, Richard, is I'm worried about their cash position.
Yeah.
I think that they're going to need more financing, and who knows, what happens then. So I bought some more Rambler metals. I'm slowly buying more Rambler over time. When I think about our best ideas, Rambler is up there. And so I've been steadily increasing my position. I bought some more FAR, and obviously then the price came off heavily this week, but still, frankly, on a 3-year, 5-year view, I think the economics of the development they have in Kazakhstan looks amazing. So I've been very happy to hold that. And I bought a bit more energy. Now, In other news, we talked earlier in the week about Talos Energy and the court case coming up over the Zama field. Well, sadly, nothing happened. The deadline came and went, and they're now guiding that it might take them another 4 weeks to reach an agreement with Pemex. If you're interested, please watch our video on it. And the other thing that happened was during the week was a reminder of jurisdiction risk. Now, I have sold all my shares in Resolute Mining, which is a gold miner, African gold miner, a few weeks ago. But I noticed during the week that the shares fell 25% because the Ghanaian government had just revoked their license for one of their mines, completely out of the blue. And it is a reminder that when you have assets in Africa and in countries with opaque government jurisdictions, then bad things can happen.
I think that's absolutely right, Keith. I think Australia, Canada, and the US are great places for owning commodity miners. Probably Kazakhstan too. I'm not quite sure. I hope so anyway.
We hope.
But some African countries, you really are at risk of having the government simply wipe out the business.
Yeah.
And you have to be very careful about the sizing of positions.
Absolutely.
Well done for getting out in advance.
Well, yeah. I just sold all the gold mines. I don't claim to any special knowledge, Richard. But this is the share price. You can see it fell 26% on the news. And that is it.
Good. Well, thank you very much for that update, Keith.
You're very welcome. Well, thank you all for watching, and I hope you will press like and subscribe to the channel. And it is goodbye from Richard Wheater.
And it is goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.